Hi, in this chapter we are going to talk about stocks and bonds. Stocks and bonds are instruments used by companies to raise funds. So when a company needs money, it can either issue stocks and get money from investors, who are then called stockholders, or it can borrow money and issue bonds, and then the investors are called bondholders. In this chapter, we define bonds very broadly to include any form of lending by investors. So even if a bank lends money to a company, we would call it bonds, though technically that would not be correct. So when a company issues stocks or bonds, investors buy these. And in this chapter, we are going to analyze stocks and bonds from the viewpoint of investors, not from the viewpoint of the company. So for the investors, stocks and bonds are opportunities for investment. For a company, stocks and bonds are the instruments by which they raise funds, or stocks and bonds are sources of finance. So what are the risks and returns to investors in stocks and bonds? Well, stockholders expect dividends and bondholders expect interest. Now the difference here is that dividends can be paid only if a company makes profits, but interest would have to be paid whether or not a company makes profits. Bondholders can expect to be repaid by the company after a specific period. This is usually called the maturity period. So a loan is usually for a fixed period, and at the end of that period, the company is expected to pay back the lender. Stockholders are promised no such payment, even though occasionally a company may buy back stocks from the stock market. So bondholders have a contract with the borrowing company for interest payment and repayment of principal. So what this means is that this contract is enforceable in a court of law. So bondholders are protected by a legally binding contract. But stockholders have no such contract. If a company does not pay dividends, stockholders cannot take the company to court. By the same token, if a company does not manage to raise the price of those stocks in the stock market, stockholders cannot go to court and sue the company. So if you take all these factors together, you can see that investors in stocks take much higher risks compared to investors in bonds. So how does an investor exit from his investment? Stockholders usually exit by selling their stocks in the stock markets. As I mentioned before, occasionally there can be buyback of stocks by the company itself. Bondholders can exit either by collecting the repayment made by the borrowing company or by selling their bonds, if the bonds can be sold in a bond market. So, for example, a bank loan would normally be squared off by a company by repayment. A bank loan could not be sold in the open market. On the other hand, if a company borrows by issuing bonds, the bondholder can still sell the bonds in the bond market as long as there is a liquid bond market available. So stockholders who take higher risks expect a higher return compared to bondholders who take less risk. So returns to bondholders, however, is limited. So bondholders can at best expect to receive the interest that has been promised to them, that has been contracted with them by the company. Returns to stockholders is unlimited. So if a company makes more profit, it can pay more dividends. If a company makes very, very good profits, its stock market prices are most likely to go up. So stockholders have unlimited upside. So what would you like to be? An investor in a bond or investor in a stock? So this depends on what kind of risks you're willing to take. As a stockholder, you take more risks, but you can expect higher returns. Note the word expect. So what is the big picture? Well, stockholders invest in stocks in a company, and bondholders lend money to a company. So these are the two broad categories of investors, and from the company's point of view, these are the two broad sources of finance. In return, a company will pay interest to its bondholders, and it will pay dividends to its stockholders if it has enough profits and chooses to pay dividends. A company's performance affects the price of the bonds in the bond market. For example, if a company's performance is very poor and it looks likely to default on its interest and principal payment, then the bond markets will mark down the price of the company. Likewise, a company's performance will affect the prices of its stocks in the stock markets. So what happens in the bond market affects bondholders, and conversely, bondholders influence what happens in the bond market. Likewise, stockholders are affected by what happens in the stock markets, and in turn, stockholders affect what goes on in the stock market. More can be read in chapter 3 of the book.